So we're going to cover how the later life lending landscape has changed. I say it is changing, it's changed. Realistically, if we look at what happened last year with Consumer Duty and also with the FCA report, landscape has already changed. And hopefully it will continue to evolve, at pace this year. And if we look at how you can support your clients over 50, so that's our job as a lender to support you so that you can support them. And of course, a really important part of what LiveMore does and what attracted me to this role is the fact that we're so flexible. I'm a big fan of later life lending. I'm a big fan of mortgage world, and frankly, I'm a user of mortgages. So I tend to see the world as I would like to see it for myself as a customer, or my family might want to get involved with the sector. So, more affordability, more products, more properties. Effectively, if you're struggling to place a case, then the chances are, hopefully, Matt and his team will be able to place that case for you, which of course, in turn means not only helping more customers, but also increasing your income. So hopefully LiveMore is a good place to come and prop up that income from those hard to place cases. So I've sort of referred to the big changes that are happening in later life. Frankly, they have happened. Consumer Duty last year, £1 for every time we've heard those words over the last couple of years. We'd be fairly rich people. And of course, the FCA, when they came in and looked at the sector, unfortunately, when they did come in and have a little look at our sector, particularly the later life sector, they were slightly disappointed in some of those later life outcomes that ultimately consumers ended up with. And of course, now more than ever, it's essential that we start to look at affordability and not just look at it, but document it. It's really, really important that should you get a knock on the door from the FCA in a year or 2 or 3 years' time, you're able to document and illustrate exactly what's gone on in your practice and how you've advised those clients as they transport themselves from mainstream and into later life lending world. And of course, traditionally, when we talked about later life, we were only talking about equity release, really. But RIOs, TOs, capital interest, people going through divorce in their mid years, if you like, in their 40s and 50s, people taking, of course, dealing with interest only mortgages as well, taking that debt into later stages of life. This is very, very commonplace, and it's a huge part of the market, as we will see. And when we talk about huge, it really is vast. When you consider, for example, just looking at the equity release sector, in its best year ever, a £6 billion sector. Last year, we think the figures are roughly about 2.7, 2.8 billion. This year, we're hoping that it will be around about the £3.5 billion mark. We're definitely going to see a recovery of sorts. But of course, that's just equity release, which is just one tiny part of the later life lending world. I mean, just look at these figures. 2 billion of interest-only mortgages are expected to expire over the next 10 years. The Bank of Family is now effectively, I think, the 9th biggest lender in the country. If it was to be a regulated lender, it was something around about that sort of 8 to 10 billion pound being gifted. And we see those figures going up year after year after year in the time that I've been talking about the bank of mum and dad, which of course isn't the bank of mum and dad. It's the bank of nan, granddad, uncles, aunts, just about anybody in the family who has some wealth, who may want to help younger generations onto the property ladder or through their other financial needs in life. So later life is becoming mainstream because as we live longer and and our needs for mortgage lending goes into later years, it doesn't matter really who you are. The chances are you're taking some kind of mortgage into your 50s, which of course becomes midlife lending. And I think that's my big mantra. It has been for the last 6 or 7 months, even before I joined LiveMore, is that if you're 30 to 40 years old, you're looked after by mainstream lenders, mainstream brokers, and that's fine. If you're in equity release world and you're over 70, you're probably well served by the equity release market in general. But actually, the real problem child is the 50, 55, 60, 65-year-olds who are taking those mortgages past retirement age. And when we look at that, there's in the UK, the 50 plus housing wealth, 2.8 trillion pounds. It's huge. The 50 plus market in terms of the back book, 130 billion. And of course, the annual 50 plus market, 28 billion, all dwarfing the traditional later life stroke equity release market. So the size of the market and the opportunity commercially and to help your customers is absolutely vast as we look at it right now. And of course, this does open up, the events of last year does open up a new era for later life lending. Leon, who's CEO of LiveMore, says, we are firmly in the view that an affordability assessment should be undertaken in all cases before any decision is made about going down the lifetime mortgage route. And like I just said, that's only a small part of later life lending, but it's still significant. And I think that's one of the things that the FCA took away last year, was that maybe in true later life and equity release world, those 70 plus clients, maybe those affordability calculations weren't done, when in actual fact people may have had other options available to them. And when we talk about other options, mainstream mortgages, moving into later life lending, and then of course that problem child of midlife lending that sits between the two and creates such complexity for financial advisors. And then of course we've got capital and repayment, interest only, and of course equity release as well. So it's really, really becoming very complex for financial advisors. And we at LiveMore are looking at various different ways to try and help and support you through the course of the year. More tools coming. We've already got a very sophisticated tool on our website that's available when you're dealing with customers who are taking any form of mortgage past standard retirement age. And of course, standard retirement age isn't necessarily fixed in stone anymore, because of course, the world of pensions and the world of retirement has become far more flexible in recent years. So LiveMore offer a truly agnostic product range, but what does that mean? What it means is we're the only lender in the UK that currently deals with interest-only mortgages, with capital and interest mortgages, with retirement interest-only mortgages, and also with equity release. We're the only one that specializes in looking after those mid to later life customers. So if you look at our interest serve range, our customers start at the age of 50. So if you're sourcing or you're using Knowledge Bank to look for solutions for your customers, those options are available to the over 50s. And of course, we've got equity release starting at 55. Of course, with Rio, with interest-only mortgages, with capital and interest mortgages, we are, of course, looking at affordability. And of course, when we get to equity release, well, we're more concerned about underwriting the property rather than the income and obviously the status of the client. So it's not really that complex. You've got 3 different types of mortgages that most mortgage brokers are aware of. It sits in a normal world, but how can we help those customers transition between mid and into later life lending and create actually a strategy for customers? Because I think that's the next thing is our financial advisors, mortgage brokers in the marketplace pushing back on their customers and actually formulating a formal strategy that goes beyond the next 2 or 5 year fixed. I'm sure that many are, but I know that some aren't. So it's really a question of how we as lenders can support those brokers with that particular challenge in particular. And with that, we do have our smart matching engine. So this is a very sophisticated tool that sits on our website. And this will effectively, in a few minutes. And by the way, I was speaking to a mortgage broker who phoned me up, a friend of mine who phoned me up and said, Les, look, I don't really know what to do with this particular case. I think it sits in real world, but I've never done one before. I don't know how it works. And I said to this chap, look, it's okay. Let's just go on to the affordability calculator. Let's go on to our smart matching engine and just see what your client could potentially achieve. And what the client could achieve was far greater, obviously, in the interest serve world than it was in equity release world. They couldn't achieve enough money with a lifetime mortgage, but what they could do is look at Rio. And of course, I was able to help and guide him through that process. But of course, so you can see here with the graphics. So this is a particular customer that's had their details put in. And by the way, this was a first time look as a complete novice on the phone to an advisor. I'd never looked at the engine before, literally just typed the information in like it was I was an advisor, and this was my first time visiting the site. Within a couple of minutes, we've got these outcomes. So it just goes to prove that, you know, looking agnostically across all product sets can prove dividends. And we had a case also, another friend of mine, and that's the thing about being an ex-broker, you've got a lot of friends who are brokers. Another guy had a case last year, wanted 50% loan to value on a particular property in Richmond, wasn't able to get that with equity release, could only get to 187,000 against a 500,000 property on equity release. At that particular stage, we gave it to LiveMore, who were actually able, against this chap's income, because we consider so many different types of income that Matt will cover later, we're able to get him up to the 300,000 mark. He had a £250,000 mortgage to repay, which otherwise he might have been selling his property, and of course was able to achieve the additional sums that were useful to him and his family. So it just goes to prove that you mustn't make assumptions about what people can and can't afford and how much money might be available to them. There are a lot of very, very good solutions available through LiveMore. And when we say LiveMore, more, and more. If you've got 50 clients who are over the age of 50, LiveMore does offer more affordability. So before I joined the business, that in that period of time where I was going through the interview process, I phoned quite a few of my friends up to speak to them about LiveMore and to get a little bit of more research from a personal point of view in why is it you are using this business? Because I wanted to know that before I came into the interview process. More affordability was definitely up there. We were able to lend the information that I took from the people that I spoke to is that they use LiveMore because they were able to lend more money to their customers. The property criteria is very, very wide, regardless of whether you're looking at interest served or equity release, and effectively more products. They knew that if they came to LiveMore, they were able to be able to supply the product range that was good for their customers. But in the main, it was affordability and then that underwriting criteria, such things as being able to lend on properties with spray foam. And you know, I believe that on this morning, on one of the TV programs on BBC One this morning, this particular matter was picked up regarding spray foam insulation and how people were unable to sell or mortgage their homes because of it. So, you know, those are the types of things that we can consider. And I won't steal Matt's thunder for slightly later on. So we bring a can-do approach, and that's the one thing that I love about this place. As a complete newbie, I can still look on this business from the outside as such. I've got that wonderful first month or so of being with a business where you can look at it from an external's point of view before you become institutionalized within the business, and also have that internal intelligence, if you like, that I receive on a daily basis from the teams that are in this business. And I have to say, the can-do approach seems to sit across the business from the top, from the CEO, all the way down through the teams. So whenever I've asked for any information, whenever I've asked if we can look at a particular case, or we can, you know, we can consider something, the answer is always we can absolutely consider it. We'll definitely look at it. We can't always say yes, of course not. But the can-do approach seems to be you know, completely within the culture of this business. And having met Matt's team, who are currently beavering away in an office not so far away from me right now, and hearing them on the phones, I can see them trying to find a way to say yes rather than trying to find a way to say no. And as an ex-broker, I can say that that's probably one of the biggest things I always wanted from a lender was, can I go to a lender, have a conversation with an underwriter, and will that conversation be, how can we possibly find a way to say yes? And with that, I'm going to hand over to the very experienced Matt, who will now take you through the underwriting approach from his side of things. Thank you very much.
Thanks, Les, and yeah, afternoon, everybody. Thanks for your time today. Just following on from what Les was saying then, from an underwriting and credit perspective, we want to make sure that relationship is balanced with our brokers. We're a solutions-based lender, as Les has touched on. We've got a whole range of products that enable us to, in the majority of situations, you know, enable us to find solutions for your clients. So, for example, we're very aware that you as brokers, you know the case, you know it a lot better than us. You may know the different income streams that customers have, which we'll come on to in later slides around all of the different income types that we can accept. but we want to work with you, and we will work with you in relation to finding that solution. Don't get me wrong, direct access to underwriters gets branded about quite a lot. So in reality, obviously, what that means for us at LiveMore is that we will be proactive with that. We won't fill your inbox with loads of different emails about things if you don't need to hear from us. But what you'll find is we'll be on the front foot with you in relation to finding a solution for that case. And that's not just with, for example, criteria. It's in relation to actually how the actual process will come through from an underwriting perspective. We like to keep it very simple in relation to the documents that we request, for example. So therefore then there's a checklist guide on our broker portal which details exactly kind of what we need and when we need it. And again, we like to make sure that we keep things very simple as it comes to that. And for example, if there's any requirements that are a little bit unusual, which is rare, we'll always make sure that you have a general understanding of why we need that document, so that therefore then the end client also has an understanding of why we may need certain documentation. But fundamentally, at the heart of what we do from an underwriting perspective, exactly what Les was talking about earlier, it's ensuring that we can find a solution. It's been proactive with that, and we really will then tap into your insight in relation to the overall application, so that we can then filter it into the best product offering that we have for that client.
Perfect, Matt. So next slide, I'm guessing.
Yeah, please. Touching it before, just to give you a flavour of the types of income that's welcome. Essentially, we consider all types of income. Employed salary up to 75. In majority of cases, it's we're happy to take it to 80. Self-employed, again, we see a lot of applications where we have a self-employed application on a RIO, for example, where we're actually using that income indefinitely. So common situations that we see for cases such like this are, you have somebody who is a director of a limited company. There isn't a key dependency on the individual in relation to the day-to-day running of the business. So it then enables us to use the dividends drawn from that business way past a normal perceived retirement age, which we know for that applicant doesn't exist. So we're not just going to, for example, on a RIO, cut that income stream at 80, for example. We can take that indefinitely. I've got a couple of instances and case examples later where we can use like retained profit as well in relation to self-employed. So it's not just necessarily cut and dry around salary and dividends. We can be extremely flexible in relation to the type of incomes and the type of streams that the applicants are taking money out of the business for self-employed. And as you'd expect, we take pension income, but we can also take future pensions, for example, that aren't yet in drawdown. So again, using that as an example case, we might have an application again using a RIO where an applicant is currently employed, but they're going to retire in 10 years' time. They've got a pension pot. They're still currently paying into that pension pot, which we will take a percentage of those ongoing contributions, so that the pot will then grow. And then at retirement age, we will then stop the employed income stream and then switch to the future SIP pension scheme. So these assets, these investments, don't currently need to be in drawdown for us to consider them at different life stages of the overall affordability. And as Les touched on earlier, our broker portal is super efficient and easy to use in relation to where you need to input these, and it does all of it for you in relation to when it starts using different income streams depending on retirement age. So it's really easy for you to input that based on the client's circumstances. And we can use foreign income. So most commonly we see foreign pensions, but we can use as well rental income for foreign income as well. And we can use rental or lodger income just traditionally within the UK as well. Touch on retained profit, and we'll go into more detail around that in relation to a case study later. But when we're assessing self-employed cases, because we manually assess the profile, it doesn't just need to be, for example, if COVID's impacted income, it could be anything. For example, we're well aware that things happen in life and within business. So if we do have a case, for example, that 2021 figures, something's happened, could be COVID, could be a life event, could be something within the business that's just caused there to be essentially a blip. And we can see that then in the most recent accounts, that business is back to the trading levels before that. We're not going to then penalise the client for having that one bad year, for example, whether it's COVID related or something else. that then really is a great example of how, by the way that we manually assess the applications, the underwriters then work with you to find that solution. So it's a really good example of how that works. And with all our pension incomes, if part or all of that pension transfers, again, when that's really helpful is, for example, on a RIO with the death stress, we can then, with evidence of that spousal transfer, essentially take what does transfer from one applicant to another, which then, as I said, for a RIO, specifically really helps with that income stream going forward. So if we can move on to the next slides. So in addition to not just all of the incomes that we can use, as we've just touched on, we can also consider other assets. For example, things like cash savings or other financial investments. We can use equity from an asset to part pay down a mortgage at retirement. Again, linking to a RIO, if we've got a joint application, and then on the death stress, we have a problem that some income doesn't transfer, but there are other assets in the background. We can use some of that equity within those assets to then pay down part of the mortgage, and then going forward, based on the new monthly repayments on the lower balance, based on the amount of the equity that's been drawn down. So it's not just simply based on, yes, we have a really wide range of incomes. Essentially, we can use all different income streams. If we are still struggling to make the affordability for the maximum loan that the client's looking for, we can also utilize that with, as I said, other assets from equity within other assets, and also such things like cash savings, for example, or other financial investments that we can then amortize those over a mortgage term, dependent on the different product type we're looking at. So there really is a lot of different ways other than just using a traditional income stream. We're aware that clients in our demographic do have different investments and different types of investments in different places. And a lot of those they're not actually drawing anything from at the moment. That's absolutely fine. And we can use different percentages from those assets in relation to making the affordability for the case as strong as it needs to be to achieve the loan that they're looking for. And then let's briefly touch on before around property. So this slide just gives us a flavour of the types of properties that we come across on a daily basis when underwriting cases. So that's kind of close to or above commercial. Again, we've got a case study coming up that really demonstrates that. We can lend on non-standard construction, so timber framed, timber or steel framed. Up to 10 acres of land, really interesting one. So for example, if we do then have any securities that have more than 10 acres, that's not a problem. What we'll do in that instance is just work with our surveyors to essentially just take the main structure of the property and then 10 acres into consideration. So we can essentially cap it. So if you do have any cases that exceed the 10 acres, which we see a fair few amounts of, we can then take the main security plus the plus 10 acres into consideration. Properties with annexes and outbuildings, I know a fair few lenders have issues with this. It's absolutely fine. In relation to outbuildings, as I said, they can even be in certain products that we have. They can be rented out, for example, or on a holiday let. Again, absolutely fine in relation to that. Yeah, close proximity to rail lines in a similar way to kind of close proximity to commercial. We work really well with our surveying partner, which is Connells, to ensure that when we're looking at properties in relation to the actual location, and the location is putting other lenders off, for example, as long as there's not a significant disturbance in relation to a social aspect. A really good example of this is the case that we had recently that was in close proximity to an off license. Now, the off license closed at 9 p.m. So our stance on that is in relation to the fact of, from a late night perspective, that's not going to cause social disturbance in relation to outside the off license. The entrance to the property wasn't on the main high street, for example, and we were able to lend on a property above commercial premises in close proximity to that. So we work really hard, and we have a really well balanced relationship with our surveyor so that they understand essentially what the actual risk factors to us as a lender are, which then really does allow us to then have a wider scope in relation to what type of properties that we can lend on. And then lastly, in relation to I guess the key aspects that we look at from an underwriting perspective when it comes to credit is how we view credit. So, for example, in a similar way in relation to how we treat the life events with a self-employed applicant, we do the same thing when we're viewing an applicant's credit profile. We're aware that life events happen, and we're aware that as a result of that, on occasion, missed payments can happen. So we accept, and we have a product range that accepts missed payments caused by life events. We can lend someone with a debt management plan if it's arranged over 3 years ago and it's maintained to a satisfactory level. And we do, as I said, have a product range that allows certain levels of different unsecured missed payments, mortgage missed payments, and even some CCJs and defaults. We look at credit utilization. We don't have any hard and fast rules in relation to that. So, for example, if you placed a case with us and they are looking to debt consolidate, for example, which we'll go on to in a second from our loan purposes, we're not going to penalise the borrower for that or decline an application for that. We do have different plans on our lending tiers that allow applicants to raise funds for debt consolidation, even when, in certain instances, they have started to miss payments due to the heavy load that those revolving credit, especially around the credit card and the higher interest rate payments, can take their toll. So we can take that into consideration as well. And then touch on a few of these already, but these are this kind of some of the the regular kind of purchase purposes and loan purposes that we see from an underwriting perspective, as you'd expect, and linking back at the start of the presentation, as what Les alluded to, we're seeing a lot of applicants at the moment coming to the end of their current interest only term. The current lender doesn't have an option for them, or the option is completely or vastly different to their current terms that they're on. And they don't have any options in relation to their current lenders. So we see a lot of applications like that. What we're commonly seeing a lot more in the last kind of year or so is that applicants wanting a lot more certainty. So you might find applicants in those situations then wanting a lifetime fix on a RIO, because they don't want to be in the same situation that they currently were in, of having an interest only with a fixed term, for example. So they're looking for a bit more certainty going forward. But because we have all the different product ranges within our suite, we can then provide them the best option in relation to what they're looking for that links in with affordability. Touch on debt consolidation, as I said, especially if they're switching away from a capital repayment mortgage, switching to interest only, for example, you can see some really significant reductions in monthly payments compared to the high interest rates that they may be paying out on unsecured or any credit cards that they may have at the moment that they're struggling to meet repayments with. And as I said before, we can even lend in these instances where there have been credit blips, so there have been the odd missed payment here or there on different items. We can definitely find a home for that. And the most important thing for all of these different kind of purposes and cases that we see is that we see a blend of them. So it doesn't, for example, have to be someone just coming to us because they are at the end of their interest only term. They might also want to do some debt consolidation. They might also want to do some home improvements. That's absolutely fine. The majority of applications that we offer and complete on do have a blend of different purposes. And again, because we manually underwrite the applications, the underwriters can take a view on the specific circumstances to make sure that we're not only solving the initial solution that the client needs in relation to the interest only end of term, we can make sure that there's that future proofing as well, so that they can reduce outgoings or capital raise for any purpose that they wish to do as well. And then this is moving towards the end now in relation to the actual specific case studies. So this is a case we did that was in close proximity to a country pub. Other lenders declined the application due to the proximity of the pub. The underwriters at LiveMore manually assessed the application, overviewed the whole profile, liaised with with our surveying partner to make sure that they are aware of our risks and what we wanted to make forward to them in relation to what our concerns were. We were happy that there was no ongoing social disturbances that would ultimately really impact the future saleability of the property. And on the back of that, we were able to offer the client what they needed, which in this instance was 300,000 on a 500,000 property. And then being able to give that immediate 5-year fixed rate, which gave the client that certainty for a shorter period of time, and then that will then switch onto the RIO product indefinitely. So then the client didn't have to then worry about finding another provider in the future that may not lend on that property, with it being an open-ended REA mortgage. This is a really good example of how we've worked with our surveying clients to make sure that then we're happy with the risk factors of the property when other lenders did have concerns that, I guess, from more of like a tick box perspective, okay, it's near a pub, we won't do it. What LiveMore will do is delve more into it, find out about the actual specific property, as opposed to just having a hard and fast rule of we will do that, we won't do that. As we've spoken about consistently throughout the presentation, we're all about finding a solution where we can, and this really does demonstrate that.
Yeah, it's a good one, man. And actually, just in my experience over the years with equity release, it's always been a crazy thing to me that, the country pub's an attraction, isn't it? You don't want to be necessarily next to the wrong pub in the wrong part of town, but when it comes to village life, stumbling distance from your local pub's actually a salient point, isn't it? So yeah, it's good that we're able to consider those, because for me, this outlines from an outsider's point of view. This does outline the sort of sensible side of the underwriting criteria that we have here, because I remember back after the mortgage problems 2007 2008, I remember one lender coming up. They were saying no to everything, and they actually came up with something called the common sense department, which was their underwriters, specific senior underwriters. And it just seems that here we've got a common sense department as standard, so it's good to see it.
Thanks, Les. Yeah, so next one's a really interesting case. Spoke earlier in relation to self-employed and how we go that extra mile in relation to assessing self-employed. In a similar way, in relation to what we were just speaking about around the property, around having hard and fast rules of, okay, we only ever use salary and dividends, for example, we are well aware that in a lot of instances, people who run businesses take what they need, for example. So an SA 302 may not be an actual true reflection of what they could have what they could have drawn from a company. This is a really interesting case where exactly that happens. Applicant was essentially just taking what they needed from the business. We on the full underwrite of the case, we assess the accounts. We clearly see that over a prolonged period of time, the applicant could take more out of the business if they needed to. That shouldn't then penalise the client in relation to then when they do want to borrow, in this instance, a fairly sizable mortgage and loan that they needed. That shouldn't then penalise that client. The client has demonstrated to us that they can take it if they need to. So again, we're able to manually assess the income along with the overall profile. We're able to get comfort that the applicant can do that and is sustainable to do that in relation to the business performance. And then we're able to then look past a more traditional just salary or dividends, for example, drawings from a business, while all other lenders were quite rigid in relation to their approach of what income streams they take. LiveMore was able to then achieve the loan size that the applicant needed by looking, as I said, at the true picture, essentially the true reflection of the applicant's affordability, as to just looking at what they've drawn on 1 year. And then the last case study is a really nice one. It really demonstrates then the different kind of income streams that we can use in relation to looking at affordability, which we touched on earlier, and also then embraces one of the most kind of common loan purposes that we're seeing at the moment, is gifting. Gifting for family, helping family, for example, get on the property ladder, which this case study highlights. But it also then highlights in relation to the different income streams that we use. So, for example, in this case study, the actual SIP pension that was used wasn't actually in drawdown. The applicant was employed, and they were at state pension age, but they hadn't actually started to then use their actual SIP income yet. So we were able to then get the case through based on the employed income, and then at a plausible retirement age, we were then able to then use the SIP pot which the client had. They were making ongoing contributions to it. So what our affordability calculation would do is then use a certain amount of those ongoing contributions, which then increases the pot size. So then when that employed income stops, along with then the state pension and the actual then drawdown from the SIP, the application was then affordable based on the different types of income streams at different times. So it's really important not to just look at, okay, what have we got now? It's also looking at, right, what else is there? And as I said before, in the majority of instances, it's not actually things that at the moment or investments or assets that are actually being utilized, but we can utilize them to make sure that in majority of cases, we can actually achieve the loan size that the customer's looking for, where in a lot of cases our competitors can't because they don't have the ability to use those different income streams, investments. It's all about kind of what's the situation now. We like to look at then the wider picture because we're aware of especially within our demographic, there are different assets, investments, and income streams that are possible throughout the lifespan of the client, not just now. So this is a really interesting case that we got through.
It's interesting one, that right? And literally hundreds of thousands of people helped onto the property ladder every year through some kind of gift, whether that comes from investment, savings, or alternatively some form of mortgage. And it isn't just equity release; it's just used for that as well. So quite often you'll see, obviously, capital rich older people trying to help out income rich younger people within their family. One of the things we do sometimes see is we see people reducing by having that bigger deposit, a little bit of help from mum and dad and granddad, reducing obviously the cost of the large mortgage because they've had that bit of help. So they've got 10% deposit, they get another 10 from family, and it reduces the cost of their overall borrowing because they've effectively borrowed what they need to borrow across two houses, and reducing that overall cost. Really clever financial planning for mortgage brokers, I think, recommending that.
And yeah, this is so this is the underwriting team, small team, really big on experience. All of the team has worked within specialist mortgages and later life lending as part of their recent experience. And as I said, I guess essentially the reason we're sharing this with you is that we are proactive. We do want to work with you, and that's what really kind of is at the essence with us is within a team. So you do find, and hopefully, I know that there's some advisors on the call that have used us before, that we're here when you need us. And like I said at the start of the presentation, what that means is we're not going to, for a straightforward application that comes in and it's really, it flies through the process, absolutely fine. More for the cases that then need our help in, you'll find that we're really proactive with you. And essentially, we want to make sure that that relationship is balanced. We want to get insight from you in relation to the overall case so that can then aid us find that solution, and we will be proactive with that. It won't be on the back foot. So yeah, please do reach out to the team when they've got an application of yours. I'm always available again to chat over any potential applications that I can then liaise with our sales team in relation to making sure that we can find solutions for those instances and scenarios that we've been discussing today.